in 5 years' time, will Manulife hire more people or less people?
Gen AI is going to make you more efficient, so it will slow down the pace of hiring for sure.
Do you think the market today is a little bit complacent?
I'm not sure investors are putting enough risk premium on that volatility right now when markets are at an all-time high. No one wants to place bets on any one particular place anymore. You have to be committed. You have to take a long-term approach to China.
Nice to meet you again. Nice to meet you again. So what's the purpose of this trip? Okay, we're good. Let's go.
How did you find Dallas?
It's good?
Yeah.
It's good. It's good. It's good. You know, sentiment towards China now.
Shall we go, gentlemen? You've been joining me in this studio for 3 years in a row,
Yeah.
and very welcome. In the past 2 years, 24 and 25, you told me that you felt that the investor sentiment was improving. And you are right, we saw the solid market performance. So how about this year?
Yeah, so I think you are seeing it start to improve, and I met with the team yesterday, and we're seeing that come through the results of the business as well. I think you've also seen, in the first quarter, you've seen the growth been supported by trade, by industrials. I think the big question is it sustainable or not? The two areas we're really watching are just, is there further support for domestic consumption to drive the growth locally? And the other one is just continued stabilization of the housing sector, right? That seems to be moving in the right direction, but that's something I think investors are watching closely.
Generally, you are the leader of one of the most important asset managers in the world. So what is the sentiment towards Chinese assets now, currently, in the global investors community?
Well, I think from a global perspective, and again, this is the lens we look at, the opportunity for growth in China in particular, the long-term prospects hasn't changed. It's a massive pool. You're seeing accumulation of wealth in the mid-market. You're seeing investors get more sophisticated. You're seeing non-financial assets rise faster than financial assets. So it used to be housing that really drove a lot of the growth. Now you're seeing the non-financial actually grow. So money's coming into the capital markets now, and that's a good thing. I think people are, people need to save. The people are living longer. And so we are seeing that formation of capital markets and the investor come in. I think the other thing too is, from last time I was here, a lot of the investors, markets were struggling a little bit, property values were down, and so they didn't have the confidence to really put money to work. And I think you've really seen that come back, particularly in the equity markets.
Paul, we are just 4 months into this new year, 2026. We have already witnessed a lot of crazy things in the world, and we see the market volatility. So how much volatility are you expecting this year?
I think we'll continue to see market volatility until we get clarity, particularly as it relates to the geopolitical situation in the Middle East. And I say that because what markets want is clarity. When they don't have clarity, that's when you get volatility. So I would say that would be the first thing. I think the second thing that's still weighing in the back of investors' minds is, if geopolitical continues for a period of time, what's the impact of energy prices on inflation, on economies, on growth? And does that have a secondary impact that isn't reflected yet? So I think the timing of it is also weighing in on investors, volatility a little bit of the outlook. And is this just temporary, or is this something that's more sustainable? I will say, from our perspective, what it does do when you have periods of volatility is it creates opportunities in the market. And I think that's when active managers typically have the benefit, because, when there is volatility, everything tends to move in motion, and not all companies are created the same. So you tend to see opportunities in markets like this.
Do you think the investors here, as you said, the conflict in the Middle East has not settled yet, but the global market, especially the United States, reached new high over and over. My question is, do you think the market today is a little bit complacent, which means underestimating the risks now?
I think there's some truth to that in your comment, in that you are seeing markets at high, but we don't have clarity yet. I think the reason you're seeing the highs is that markets are expecting clarity and they're expecting it to resolve itself relatively quickly. I think they're kind of pricing that into markets, which is what you're seeing. And when you see some hiccups there, or maybe it's not going to happen, you've seen markets pull back pretty quickly just in the last little bit. I think investors have almost come to accept the volatility, but they're betting that their clarity is coming. Even in our base case and outlook, our base case is that this will resolve itself, likely by early May and continue on. As we look at the outlook, we have, 3 different scenarios. That's the most likely here, is that it does resolve itself. But I'm not sure investors are putting enough risk premium on that volatility right now when markets are at an all-time high.
The thing is, how are you advise your clients to navigate in this kind of uncertainties?
So there's a couple things we do. One is trying to make sure investors focus on the outcomes and why they're investing in the first place. And I say that because typically retail investors tend to get out of the markets at the worst time. So when markets are volatile, they pull back. People get scared and they tend to leave the market and miss the recovery. So we try and make sure investors are really focused on the long term to try and see through the volatility. The second thing is to try and make sure that the portfolios are somewhat resilient. And what I mean by that is, you have diversification with public and with equities and bonds. Now you're seeing alternatives, private credit, other asset comes in to provide further diversification. That's the second thing, which is helping provide not just better returns, but again, more diversification, less volatility in returns. And the third one is around portfolio construction. And this is something we're spending a lot of time in all our portfolio teams globally, is to making sure that as we look at the investment portfolio, as we're adding securities and removing securities to it, because we do a bottom-up view, what does adding that security do to the portfolio? Are there unintended bets you're making on a sector in there? And so our goal is to make sure that in our portfolios, we're participating in most of the upside, but in exchange for most of the upside, we try and limit the downside when there is a pullback. And so we try and build the portfolios to be a little bit more resilient on that, because investors care more to preserve on downside than they do maybe not having the highest return, but participating in most of the market. There seems to be a lot of momentum behind the market, and it feels like it's just waiting for clarity to continue its run.
Are we in a process of transitioning from a US-centric to a multipolar investment world?
No one wants to place bets on any one particular place anymore.
Yeah, you mentioned a keyword, diversification. Before 2025, the belief in the market is something like the American exceptionalism, the US exceptionalism. But starting from 2025, the global investors started to reassess the American exceptionalism and looking for elsewhere to invest their money. So how would you anticipate this kind of diversification play out going forward?
Well, I think what we've started to see is a shift from some of the equity exposure we've seen to the US to more of the international markets. I think you've seen a lot of markets here in Asia start to get their footing, emerging markets, as well. So we are seeing allocations, a little bit more diversification of some of the traditional allocations away from the US. US has also had quite the run with, a lot of the technology, the AI companies. And so a lot of investors are taking this as an opportunity to maybe diversify some of that and pick up on some of the Asia growth we're seeing more broadly. And then I think just alternatives and privates generally are starting to make their way more into the retail investor through traditional retail vehicles as well as retirement plans. I think we're going to see more of that. And that provides further diversification than just your traditional equity fixed income, but it also requires a little bit more patience and duration in terms of how long you hold those assets.
Are we in a process of transitioning from a US-centric to a multipolar investment world?
I think that's where diversification is going to be key. No one wants to place bets on any one particular place anymore, right? And I think we've seen markets are a lot more correlated, different markets than maybe we thought. And so trying to really understand how do you get the diversification you want as an investor at a portfolio level to try and really minimize the risk of this, because you are seeing those disruptions. And so I do think it has driven investors more broadly to really drive as much diversification in their portfolios as they can to try and minimize that risk.
Looking ahead at the next decade, how does the Asian market fit into Manulife's global blueprint? And will we see more resources, more capital deployed here?
The short answer is yes. You're going to see more capital and resources, but it makes sense to explain that because at the global level, what we're looking to do is how do we allocate capital for the biggest opportunities to drive growth? The business that I lead, it used to be the smallest business. Now it's the second largest within the company, only to Asia insurance segment. And so because there's so many opportunities for growth here in Asia, I think you're going to continue to see more and more capital come here because you're comparing that in some of the mega trends here for growth to some of the more mature markets in North America that just don't have the same prospects, frankly, of future growth. They're big asset pools, but they don't have the same growth prospects. And so for us, we want to make sure that we're doing everything we can to capitalize on what we see in the region here.
Let's talk something about China opportunity, Paul.
Yeah.
And I've talked to many international investors recently, and the general view is China, macro level,
Yeah.
China has some challenges, face some challenges, but micro level, they see a lot of opportunities in terms of manufacturing, robotics, AI, or even pharmaceuticals, right? A lot of things like that. So first of all, how would you, Frank, assess the macro level challenges in China now?
Yeah, so it comes back to what we started talking about, which is we've seen some continued growth, which is good coming into the quarter, but we're looking for can that be sustained or not, right? And that comes back to domestic consumption to support the growth, stabilization of the housing sector. So we want to see the continued, fundamentals of growth for China generally. That's generally a good thing. But to your point, the 15th five-year plan actually outlines some key areas where regulators expect to continue to invest, right, to really support the growth go forward. And whether it's AI, technology, manufacturing, that's capital that's going to be invested. That's going to create opportunities in the market. I think the one advantage is China's such a big market. For us, there's a couple areas in particular. One is just structurally, people are living longer. People need to save more. They're looking for income solutions. So for us, one of the biggest offers we see is around retirement and wealth planning. We just see tremendous opportunity for, frankly, a lot of the solutions we have, which is income solutions, multi-asset solutions, because there's just a big demand for that, and that's not going away. The second is the sophistication of the investors they're getting more sophisticated. They're looking for more demanding solutions.
Will we see more resources, more capital deployed here?
Whether it's AI, technology, manufacturing, that's capital that's going to be invested. That's going to create opportunities in the market. You have to be committed. You have to take a long-term approach to China.
As you said, that Manulife has been operating as a wholly owned platform in China for 3 years. So during the past 3 years, what's the takeaway?
Well, I think there's a couple takeaways on it. One is, for China, you need a long-term commitment. You have to invest in the region. You have to stay committed. And listen, we've been here a long time. Our company sold its first insurance policy in Beijing in 1897, actually. So you have to be committed to the region because you have to make investments over the long term. You have to have a long-term approach. So that would be the first thing. The second thing is local talent.
Yeah.
It is the localization of the business. It's not that we're global, why we're successful. It really is the fact that we have a team that's on the ground from the region that understands the market, understands what investors are looking for, has the relationships, and really takes that and then blends it with some of our global capabilities. And so talent, localization, that's really the key for us. It's the local team on the ground that's really driving it. And that's one of the reasons I'm here, is I met with them yesterday just to understand what are the opportunities they're uncovering, what do they need from us globally? Is it more capital? And how do we just make sure they're getting the support to capitalize on that?
Specifically, what kind of message that you would deliver to your global peers who is still in the wait-and-see mode when it comes to China?
Well, I think the biggest thing, and this is my learnings over the years, is it's not a transactional country. Like you don't come in and come out of the market on a transactional basis, right? That would be the first thing. Two is you have to be committed. You have to take a long-term approach to China. And so the third one would be partnership. And I think this one's really important. While we're here in the region and we're trying to build a commercial business, we're also trying to further what the government and regulators are trying to accomplish, whether it's development of capital markets, development of retirement solutions, because they're trying to solve problems in the region or come up with solutions. And so you need that partnership with local regulators, with counterparties, et cetera, so that you're working with them to help further the cause of the local markets as well as the cause of your own organization. I think too often companies come in with just their own perspective, but you're really here as a partner in the region trying to, successfully build a business together and further the benefits. So that's probably the biggest thing I would say from our perspective of just having that commitment. And then the last one is just having the relationships with the regulators when you're here so that you have a sense of clarity of where it's going, and you can also provide input. As someone who's coming into the market and not here, locally with the team, really relying on that local expertise and commitment to see what do we need to do to really be successful here.
What steps are necessary for Chinese capital markets to further rebuild the global investors' confidence and see a sustained return of the capital? So, many international investors towards China still in a wait-and-see mode.
Yeah, I think it's a great question. I would say there's 4 things. One is clarity of direction. I think foreign investors just want clarity. And I think that's where, whether it's the 15th five-year plan, just having a sense for where things are going are really important. So that would be the first one, is just that clarity of direction. The second one would be the framework and infrastructure around the capital markets themselves. And what I mean by that is confidence in the system, right? Whether it's transparency of financial statements or things that gives investors confidence that they want to come into the market. The third one is just that the underlying growth of the market is there. So we talked about it is the fundamentals of the local economy and everything, is it enough to keep, the momentum building from a growth perspective? Investors, when they're allocating capital globally, they're looking for where are the markets for growth.
Yeah.
Right? To your point, it may have been the US one time, it may not be the next time. And so they're constantly looking where that is. So I think that confidence in the growth is there. And then the fourth one, which is a little nuanced, but where there are gaps, is looking in. I think that's where regulators can really bridge that, is getting the insights of where do they plan to go, where the market's going, because trying to get that understanding also gives confidence of where it's going to go if you're thinking of coming in as a foreign investor. And that's part of what I do when I'm here. I'm not just meeting with the team. I'm meeting with, local customers, intermediaries, some of the regulators, just get a sense for what they're thinking, how we can help. So we can try and get a sense for where do they want to take the business or the market, and what are they thinking about, and how should we think about that as a company here.
Let's talk something about the future of asset management business.
Mm-hmm.
What are the most important structural trends shaping the global asset management industry today? And consolidation, alternatives, technology, or something else?
So definitely, the first one I'd say is alternatives and private credit. We've already talked about this, but you're seeing a proliferation of that. Will continue to make its way into retail investors, whether it's through direct funds or whether it's through retirement vehicles. I think it's going to take some time, but I do think it rewards investors because it's more diversification. It's typically higher yield when you put it into a portfolio. So I think that will continue. I think you're going to continue to see consolidation.
Yeah.
We're an industry where prices never go up. They only go down. And as a global firm, you have to continue to get scale to make sure that you can offer, investment capabilities to investors at the right price.
Yeah.
So scale will continue to be absolutely critical from that perspective. I think the third one is just making sure capabilities are available the way investors want to access them. We've seen a pretty big shift in North America to an ETF structure, even for active management, away from traditional mutual funds. Even
active
here in
ETF.
Active ETFs. Even here in China, I know you have passive ETFs. And so, is that where the market will go? Is it going to be more to those types of structures because they're tradable daily, they're more liquid, and so just watching where some of those trends are going to be. So you've got alternatives, you've got the scale. I think those are probably the big ones of where the market's going. I think the other one, which isn't related to capabilities itself, is just technology and Gen AI. Mm-hmm. It's changing the game, not just from an efficiency perspective, but we're using it in how to drive better alpha, how to get information to the investment teams faster. We're using it to reimagine the customer experience, whether it's through advice, through our retirement channels. So we're really rethinking about that of how does it really change? It's moving so fast. How do we really embrace it and really be a Gen AI-led company in terms of the solutions we're offering? And I think that'll continue to change our industry for years to come.
So you mentioned AI. Let's talk something about AI. The most recent news is the American regulators had prompt warnings to the financial institutions about the recent model of Anthropic's Mythos. This is the first time that the American regulators see that the AI models is too dangerous and restricted the access to some very large financial institutions. So what's your take on that?
So I think there's a couple things. One, I would say, I think it highlights the speed of change of Gen AI and how quickly it's moving. And I think this is a good example where this is an opportunity to get ahead of where the market's going to make sure that you're building, whether it's resilient infrastructure and multiple layers to protect yourself, whether it's through portfolios we build. So I think the speed of change is changing fast. And one of the things, while we're leveraging Gen AI across our company, so I think it changes so fast, you're constantly trying to stay up to date on it. But that's really what they're trying to do. And that's exactly what they're trying to do with this particular example you reference is what could this do? What could it mean? And how do we build more resilient, security to help us protect us from that?
When it comes to AI, there is also anxiety in the labor market.
Yeah, so listen, we talk about this with our staff all the time. I mean, we've got, this is something we want to embrace. We actually think it's good for our customers. And I think the opportunity for our staff is to really have them embrace it. So one of the things we've done is made sure our employees have access to Gen AI, that they use it in their daily work to make them more productive, to free up time to work on more value add capabilities. So I think one thing is turning it away from being a fear for a lot of people into an enabler for them, because the more well-versed they get on Gen AI, the more valuable they're going to be for their own career prospects. So that would be the first thing. I think the second thing too is all of us have parts of our roles that are more mundane that we don't love to do. That's more just, those are opportunities for us to free up that time for individuals so they can spend that time more on value add. So driving efficiency, but not for the sake of necessarily taking costs out, but more for the sake of freeing up space to focus on strategy or more of the value add capabilities for individuals. But it is a balance and something that we're watching really closely, because you need to be able to bring in talent, that really understands this, because it is going to change the industry. But also, that's your future talent of the organization. You want to eliminate the ability to bring that talent in at those different levels.
Paul, let me put my question in this way. In 5 years' time, will Manulife hire more people or less people?
Yeah, so I don't know the answer to that today, to be fair. What I would say is that Gen AI is going to make you more efficient. So it will slow down the pace of hiring for sure. But I think the skill sets we're hiring are going to evolve. You're going to want people that are more well-versed in Gen AI in terms of the types of questions, how they use it, how they structure prompts, how they think about the business. And that's really what we're trying to do, is really reskill all of our employees, our staff, to really give them the tools and the power to do that. But also for the talent coming in. You're constantly going to be looking for new talent as the industry evolves.
Is this something many people call redeployment?
I think redeployment is a good term, because you're going to have individuals that may be doing something today that are going to be doing something completely different in the future. And that's really our goal. It's expensive to rehire new people when you already have staff. If you can reskill them, if you can train them, if you can repurpose them, that's the best situation, because they're still advancing in the organization. We're getting the talent we need. And so that's the big investment we're making, is just making sure we're investing in our people.